Hey, welcome back, options traders, and a happy hump day to everyone. And I thought it would be appropriate to talk about the dangers of using zero-cost collars during high volatility. Now, collars are a very powerful and popular strategy among stock owners. And the thing is, though, is that a lot of times they want to use the zero-cost collar because they think it sounds better that you're getting it for, of course, zero cost. But there's a very big cost, and the cost only increases during high volatility. So let's take a look at what that is. As always, please be sure to click like, very much appreciated, and definitely helping to promote the channel. So the collar, first off, is a strategy where you are going to own shares of stock. So let's say that you currently own 100 shares of stock and you will sell one call. Now it's usually an out-of-the-money call, does not have to be. But typically that's what people are doing because after all, they own the shares. They are still looking for a little bit of capital appreciation. They don't really want to get assigned, would like to collect the dividend. So a lot of times they're selling an out-of-the-money option. And then with that cash, they will buy one put, again, usually out of the money. So as an example, let's say that the stock is 100 and you sell the 105 call for 3. And so what they do next is they look down the options chain and they say, which strike for the puts is going to cost me $3? And then that's the option that they buy. So let's say that that is the $95 put. So if you sell for 3 and you pay 3, there's no cash outlay. That's what we call a net zero collar. Now in a case like this, notice how they are symmetrical. Do you see how the stock is at 100? We are 5 points out of the money for the call. We're 5 points out of the money for the put. We have no cost into it for the options. So the risk graph looks like this. Now, yes, it does look just like a vertical spread, which is why I said that you will usually use this strategy because you already have shares of stock. It wouldn't make a lot of sense to go buy the shares to get this kind of a risk graph, unless for some reason you were after the dividends. But again, typically it's because people already have the shares. Now, by selling off the 105 call, we put a bend at 105. It's our maximum gain. We also put a bend at 95 from the put. And this is really the reason why we sold off these calls. All things being equal, we would prefer to have not flattened out this upside, but we decided to do it because we wanted to buy this insurance. We really wanted to flatten off this left side right here, but we didn't want to have to buy this put because maybe in a high volatility environment, it might be trading for 8 or 10, 20 bucks, who knows? But if we sell off this call, we can use that cash to buy the put. So in this example, we have a maximum gain of 5 and a maximum loss of 5. It's symmetrical. And the reason again is that we are 5 points out of the money on the call, 5 points out of the money on the put, and we have no cash into it or out of it. It's not a net debit or a credit. See, if we had just sold this 105 call for a credit of 3, then the maximum gain would be 8 because we could make 5 points on the capital gain from the stock going from 100 to 105, plus we would keep the $3 from the sale of the call. But we didn't. We took that $3 and bought this put. And so that's what's causing us, in this case, to have a symmetrical outlook. But here's the problem during high volatility environments. We've talked about this before with skews. So what we're looking at is for a given expiration, we have various strikes across the bottom. And if the stock is trading, let's say at 20% volatility, we would usually see some type of a U-shaped curve like this. And what we're looking at here is the implied volatility for each of these strikes. So normally the at the money, let's call it the 100 strike, will be trading for the same volatility as the stock. So in this example, 20%. And you would certainly think that all of the strikes should be trading at 20% because they are covering the same underlying stock for the same time. But in the real world, they don't. We get these bends in them, which are called volatility skews. So in other words, as we go further out, let's say to the higher strikes, so in this layout, this is what's called an out-of-the-money layout where the higher strikes are the calls and the lower strikes are the puts. So everything above 100 is representing a call option strike. Everything below 100 represents a put option. So normally, if we have kind of a symmetrical skew, it means that if we go 5 points out of the money to the calls, we have a certain volatility. See how it's been bumped up here from the 20% line. And we would typically get that same volatility for 5 points out on the puts. So they would trade at very much the same volatilities and therefore would have the same prices. And that's what's going to cause, as in my example, where you sold the call for $3 and paid $3 for the put. Gave you a nice symmetrical zero-cost collar. However, in high volatility times, you're not going to get these symmetrical skews like this. You're going to get stuff like this. And you're going to find that you have to go maybe 10 points out of the money, and you're only going to get a little bit of excess volatility here. But if you barely go out of the money with the puts, you're paying a ton of money. The out of the money puts just get bid up to such high levels. Why? Because you're in a market free fall or some type of high volatility environment. People aren't interested in bidding up the calls thinking that the market's going to turn around and scream to the upside. No, they're looking for insurance. So they start getting into bidding wars for the 90 puts, and when that becomes super expensive, they move down to the 85 and they bid those up higher. Then they move down to the 80s and so on. They all get pumped up. So here's what happens if you wait until you are in a downturn or otherwise high volatility and you want to use collars. You're going to find that if you sell this call at this volatility, you're only going to get so much for it. And if you want to buy a put for the same cost, you're going to have to go way out of the money. So now your risk graph for your collar is going to look something like this. Yeah, you might have 5 points to the upside, but now you've got 20 points of potential loss to the downside. And that's because of the skews. You only received so much for selling the call, but again, when you turned around and bought that put, you had to keep going further and further out of the money. So again, what's causing this asymmetrical risk graph is that you only receive so much for the call. And yes, in a high volatility environment, those are going to get pumped up as well, but not to the same degree as the out of the money puts, what are called the corresponding strikes. In other words, 5 points out of the money on the calls is not going to be priced the same as 5 points out of the money on the puts. So whereas you might have gotten $3 in the past for this 105 call, sure, you might be getting 8. So yes, the volatility is high here, but in order to spend 8 for a put, you might have to come way out here to the 80 strike. That's now 20 points out of the money instead of 5 points. So the whole point of this is to understand that this is why it's so important to set up your hedges before the markets unravel. As I always say, that if you're trying to buy puts during a big market downturn, it's like calling your insurance company trying to get insurance once the house is on fire. Yes, you will find somebody to sell it to you, but those prices are going to be severely disadvantageous. Now, this also causes another problem. Let's say that you put this on and the stock does fall and it comes down here maybe to 90 and then to 85, maybe even works its way close to 80. You still took the 20-point hit from the current stock price of 100 down to 80, and yet your insurance never kicked in. And you've got nothing to show for it for the sale of this call. You've just got a worthless insurance policy. And then if the markets are still continuing to sink or volatility is getting jacked up, people say, well, let me do it again next month. And they sell this call that's just a little bit out of the money. They buy this super far out of the money put, and they really haven't insured anything. So the main message to take from this is to put your hedges on when they are not needed. This is why you always want to make sure that you are hedging your positions. Don't wait to get into a bad situation and say, let me go try to hedge this. And oh, by the way, I can do this very easily with a zero-cost collar. If you're in a truly high volatility environment, chances are it's not going to be that easy. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us at the Facebook trading group, Options A to Z, and you can find a link in the description below.